So many of you enjoyed my last video about two undervalued stocks to buy in this stock market crash, and actually many of you asked me to do a little bit more of them, so I decided to do maybe one or two of those videos every month, try to find undervalued stocks that I actually believe could be a buy at such prices, and try to share them with you guys on the YouTube channel, because my personal portfolio and all my trades and stuff, I share them with the people in my group, which if you're interested, you could click the link in the description, you could join. But I'm gonna try to share a little bit more ideas with you guys on YouTube for free. So again, I hope you're enjoying those things. They don't get a lot of subscribers, but they get a lot of likes because you guys enjoyed them. So all I ask, if you could maybe please press the like button and maybe consider subscribing if you're actually a new investor. Now, in my last video, I actually talked about two stocks. The first one was CoreCivic, and I said CoreCivic is undervalued from an assets perspective, but from a PE perspective, I would prefer to buy it under $9 per share. And now CoreCivic is approaching $9 per share. But the second stock I talked about, which was below net asset value, is actually Sandstorm Gold, and the stock has appreciated a lot since I made this video. It was $4.80. Now it's $5.73. A lot of these gold stocks are actually going up. Today it's up around 7%. Over the past five days it's up 16%. And from my video 2 weeks ago, it's up over 23%. So it's up to you guys if you bought the stock, if you'd like to sell it, or if you want it for the long term. But a lot of the gold stocks have been moving with the price of gold, and maybe when gold comes down, a lot of those stocks might actually come down. So I'm gonna ignore those two stocks and talk about two new stocks that I believe could potentially be a good buying opportunity at such prices. They are not as underrated and as under the radar as those other stocks. It's more of a larger cap type of stocks that I believe are undervalued. And I do prefer actually to buy sometimes larger cap stocks over smaller caps, because I enjoy smaller caps, but larger caps I can actually put a little bit more money into them than just buying under the radar micro and small cap type of stocks. And this is a company that I did two videos on, and I'm gonna talk about it maybe one more time, and this is going to be the last time. And this is CVS Health. And in my two videos, I said CVS is undervalued below $76 per share. And the stock, funny enough, it actually came below my target of 76. Now it's sitting around $74 per share. So I believe CVS is pretty undervalued at such prices, and I'm gonna tell you exactly why in this video. But I highly encourage you to watch the other two videos I did on CVS, because I talked about the main reason the stock is going down. And one of those reasons is the two acquisitions they made. And the first one they acquired is Oak Street Health, and they are trying to get more exposure to the advanced primary care space. They operate over 600 care providers, 169 medical centers. They're gonna try to expand this business. So I have pretty much a monopoly from the healthcare space to the CVS stores, from the health insurance of Aetna that they acquired in 2018, 2019. And now they're trying to get exposure into the primary care space. And I believe this is a very smart move from the management. And the second acquisition is more of a platform that I believe connects, clinics to patients and all type of things, which I don't really understand. But I think this one is an unprofitable business. But together, they likely overpaid for those acquisitions, and they total pretty close to $20 billion. And the company is selling off like crazy, pretty much the same way it sold off in 2018 over here. Whenever they were acquiring Aetna, the insurance company, the market hates uncertainty. They were scared that maybe CVS is not going to be able to do anything with Aetna, that they were overpaying for Aetna. And it was just, the market was freaking out and the stock was selling off like crazy. And since then, after this massive sell-off, the stock has been on a tear and more than doubled over the next 2 to 3 years, which has been, not including dividend, which has been an amazing return. So I believe it's pretty close to what happened before. So in order for us to try to determine if we should be worried about such acquisition or not, we can look at the track record of CVS, as now we have some numbers to talk about. And if you look at the 5-year chart between CVS and its competitor Walgreens, CVS was a little bit smarter. They did a lot of acquisitions. They were focused on growing the free cash flow, which I'm going to talk about. Walgreens was not focused on growing the free cash flow and trying to invest for growth. So what happened? CVS went up 22% even after the big drawdown. and Walgreens declined 49%. Now, in my opinion, this chart speaks for itself that CVS is actually doing something right, but the market always hates uncertainty whenever you're taking on a lot of debt. Although CVS has proved that whenever they took on around $50 billion of debt to acquire Aetna, they quickly deleverage, and they have been deleveraging every single year. And the debt now is pretty close to $49 billion in terms of long-term debt. But not only is they deleverage pretty quickly, but if you look at the free cash flow creation, it more than doubled from $6.8 billion to pretty close to $13.5 billion. It's likely going back to $15 billion whenever those acquisitions are over and CVS, grows and then have better numbers and stuff. I think it could go back to $15 billion of what they had in 2021. So the free cash flow more than doubled, and CVS created a lot of value with this acquisition. And this is what the CEO said on the earnings call. He said, the debt, we can extinguish the debt, but the free cash flow is permanent. We can always use the free cash flow. And this is why CVS did better than Walgreens. And I believe CVS will still do better than Walgreens going into the future if they keep using the free cash flow, reinvest it, take on some debt. They took on debt, 3-4% interest. I talk about their debt structure in another video. And I believe the debt is not an issue with CVS as long as the free cash flow is there. $13.5 billion of yearly free cash flow. They have some dividends, some other type of interest expenses and stuff, which I'm going to talk about. And the interest expense is around $2.2 billion, which I would have preferred personally if they lower the interest expense first, pay down the debt, and then they can acquire them. But I'm sure CVS management saw a lot of value in Oak Street Health and in Signify, and they are trying to maintain, their numbers, maintain their growth and stuff. And I believe, I trust the management of CVS because they have proven many times whenever a lot of people doubted them that they actually were doing the right thing with taking on debt and acquiring Aetna and many other acquisitions they did. So I have no reason to really bet against the management, and I'm just watching the management see what they're doing with, Oak Street Health and, Signify Health. And this is how I think about CVS. Again, it's pretty basic, not normally how I value companies, but looking at their growth trajectory of their guidance and assuming they actually do hit their $10 of EPS of guidance by 2025, which from me saying the previous growth, which is around 8% was the core business, and they're going to grow a little bit more with the other acquisitions, although they are not included, I believe they can hit their $10 of EPS, and there could be potentially even more upside based off what CVS said in this presentation. Again, $10 of EPS. The company traded at a historical around 12 to 13 times earnings. I'm not saying it's going to trade at 12 to 13 times. If we just take a basic 10 times earnings, this is $100 per share. $100 per share. And the company, as we talked about, also has a 3% dividend. So that's, again, 3% dividend times 3 years because it's for 2023, 2024, 2025. So this would add around 9%. So 9%, 25%. This is pretty close to around 35% on the upside from CBS from those prices over the next 2 to 3 years. And this actually doesn't include anything we could get from a multiple expansion where the market realized CVS value and stuff. CVS could trade back at 12 times earnings like it was trading 12 to 13 times. In this case, the upside is much, much greater, could be up to 50% on the upside over the next 2 to 3 years with CVS. And if CVS keeps up the growth over the next 5 years, it could be closer to 100%. So I'm really locking in somewhere around 25 to 30, almost 35% on the upside over the next 2 to 3 years with a pretty safe company, a pretty recession-proof, resilient type of company. And I believe it's not really as risky as people believe in terms of the debt because the free cash flow is here. And there's a lot of variability with this projections because they can actually do more acquisitions over the next few years. They could pay down some debt, which will increase the EPS as they reduced interest expense, and Oak Street Health could be a success, and maybe they will include it later on in their numbers, which is not included in those predictions. So there's a lot of different variabilities with CVS. Again, it's not a growth stock, it's not going to 10x your money tomorrow, but it's a pretty safe company, and it's very rare that I see opportunities like that to actually get something like 25, 30, 35% on the upside over the next 2 to 3 years with a fairly large cap company. So CVS is undervalued at such prices. I'm not sure how low the stock will go because it's technically damaged. I don't know how it could go. Could go to $68, could go to $62. I have, no idea. But looking at the valuation, and I said it before, I believe CVS is undervalued below $76 per share. Now, this is a totally different company, but I also believe it's undervalued. And if you're actually a trader, you're going to love this company because this company, which is British American Tobacco, it has been trading in this range for pretty much, since 2019. And you could do it many, many times. And I personally did it in my portfolio. You buy at the lower end of the range, pretty close to 34, 35. You sell it above 40, 41, 42. Then you buy it again, 35, 36. This is not financial advice, but if you're a trader, not an investor, I believe you could potentially, like buying British American Tobacco. But British American Tobaccos, they have many different brands, tobacco brands and stuff, which I'm not going to really try to go into because most of you are actually, familiar with the companies. They are a global companies. They have these brands in emerging markets in a lot of places around the world. But the company is actually a leader, not just a competitor. It's actually a leader in the non-smoking type of things, the next generation type of stuff like the vapes and many other things, the new category contribution. And now they expect this new category to be profitable by 2024, which their original target was 2026, and now it's 2024, which is why I really like this company. This company, they grew over 37% in revenues. This is a tobacco stock, but they grew 37% just from the growth they are experiencing in the new category, which is massive, massive growth. They grew around 4.6% in the combustibles, the old school, cigarette stuff, because they actually have the pricing power to raise prices. So it's a combination of, price mix and stuff, 4.6%, and the value share was pretty much flat, which again, why I like British American Tobacco, because it's not like Altria. Altria is only in the United States. British American Tobacco is in many other, emerging markets, many other countries where they actually have an increase in smoking shares, not even a decrease. So British American Tobacco really, benefits from that. And they had over 8 billion euros of free cash flow. And we look at some of the growth in their next generation product. One of their things they have, which called Views, I believe, which I'm not sure if you guys are familiar with it, but they have over a 91% market share in Canada, over 9.1% in the UK, 38% in France, 45% in the United States. They have another one called GLO. GLO has 7.5% in Japan. I mean, it's growing pretty much everywhere, and in many other countries in Europe. In Sweden, it's 57% market share. Norway, 63% market share. So they invested extremely aggressively in those type of categories, which now they are starting to pay off, and they're going to be profitable as soon as next year, which I believe is a game changer with a company like British American Tobacco. But without talking a lot about the company is basically cheap, just basically cheap on the numbers. And it's mainly cheap for two reasons. The first reason is because a lot of people don't want to invest in such industry, which I actually understand. Now, the second reason why, it could be, somewhat undervalued is because it's mainly listed in the UK, which there's a lot of activist investors are trying to push for the company to list in the United States because they could actually get a value multiple expansion. And they are not getting this multiple expansion being in London. So they are trying to bring the main listing in the United States, and that could potentially bring some, multiple expansion for British American Tobacco. But the company is trading at 7 times free cash flow. Its mean free cash flow multiple is, 14. It traded as low as 7 times. So it's pretty nearing, the low of its range in terms of free cash flow multiple. And it traded as high as 25 times free cash flow. And that was somewhere in 2016. Now, looking a little bit more, which is something that people have a concern with, which is the debt with the company. Because these type of tobacco stocks, they have a lot of debt. And British American Tobacco has over $38 billion of long-term debt. Yes, they do have $38 billion of long-term debt, but the company has pretty close to $10 billion of free cash flow. And yes, they do have a dividend. The dividend comes pretty close to $5 billion. So the dividend is well covered from the free cash flow, and the free cash flow, the rest, around 4 or 5 billion, they can actually use it to pay down debt and do many other things, and their debt is fixed at 4% interest rates. So I'm personally not very worried from British American Tobacco's debt. In fact, I do like that the company has so much debt because they can keep the 4% rates and they can actually use inflation to their advantage to increase prices in those cigarette stuff and the e-cigarettes and the alternative smoking type of things. And this will really help British American Tobacco in the long term. And the company has been growing, and they announced a guidance of 3 to 5% revenue growth next year. So it's at 7 times free cash flow. It's growing 3 to 5% revenues. They have their other new categories growing 40-50% revenues, and they're going to be profitable in 2024. To me, this is an amazing value proposition, and the company is yielding pretty close to an 8% dividend, which is very well covered. So I told you, everything about, the company. If it wasn't a tobacco company, you might go and buy it tomorrow. But because it's a tobacco company, many people just don't want to touch it. But I believe at $35 per share, the company is extremely, extremely undervalued. And if you're good with options, you can do many things with this company. You could buy it at 35, get the 8% dividend, sell some covered calls and stuff. You could end up with over a 20%, annual return from some covered calls type of stuff, and then the 8% dividend. So there's a lot of things you could do with it. If you're an options person, if you're a long-term investor, you can hold it for the dividend and the growth in the new categories. If you're a trader, you could actually trade it, buy it at 34, 35, try to sell it above 40. So it pretty much has something for everyone as long as you're open-minded enough, to see the value. So those were my 2 stocks for this month in March. I'm going to try to do another one for April about 2 undervalued stocks that I believe are a buy in this stock market. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.